I'm Michael Hainsworth. Canada's place in a global portfolio is often debated, particularly when our market trades at a discount to the United States. But if we step back from the daily noise, a different picture emerges. We have a market anchored by stable financial institutions, strengthened by resource sectors that hedge against inflation, and supported by businesses whose long-term fundamentals matter more than quarterly sentiment. Meet Don Simpson and Eric Mencke. So gentlemen, if there was one thing you wanted a Canadian investor to know about the Canadian market going into 2026, what would it be?
I would say don't underestimate it. I think we have a lot of high quality businesses here in Canada that right now is being overshadowed by trade talks and tariffs. And I feel like if our government can do what they're promising, Canada has a lot of opportunities and a lot of investments that are going to be made that could grow the economy over the next 5 to 10 years.
The worst thing you can do is wait for us to do a trade deal. Because if we do the trade deal I hope we do, it'll be too late. And then the uncertainty is gone. And you want to buy when there's maximum uncertainty, not when the market knows what the deal's going to be.
Coming up, the long-term forces shaping Canada's investment case, how to separate volatility from true risk, and how to define a quality investment in a market that rewards patience. But first, if you owned a company, you'd get to keep the profits. It's no different for publicly traded companies that offer dividends. While you only get to keep a small percentage of its profit, you benefit from the success of the company. Dividend investing provides both regular income and the potential for capital appreciation. It's a strategy that's gained traction among young Canadians who want consistent cash flow while still building long-term wealth. Here's how it works. A dividend is usually paid to investors every quarter, every 3 months. Companies that pay dividends every 3 months tend to be stable. They tend to be established businesses, your banks, your phone companies, your grocery store, that sort of thing. The percentage you get is called the yield. While their stock prices may not skyrocket like a tech startup, you get rewarded for steady income along the way. And that income matters. It can be reinvested to buy more shares, fueling compound growth, or it can provide cash flow when you need it most. During bear markets, when stock prices slump, dividends can act as a cushion. You're still being paid even while you wait for the markets to recover. But not all dividends are created equal. A sky-high dividend yield can be a red flag, signaling that a company is in trouble, and it may cut its dividend. Investors looking for a sustainable payout ratio, dividends backed by strong earnings and healthy cash flow is where it matters. Dividend investing isn't just about collecting checks. It's about building the foundation for stability, resilience, and long-term growth, one payment at a time. Don Simpson and Eric Mencke of Dynamic join us now. Thank you for joining us. Don, I suppose we should really start at the top. Canada trades at a valuation discount relative to the United States and the global markets. Why?
This is it's interesting because having done this for a long time, it's not always been this way. There was a time when people actually paid a premium for Canada because of the businesses we have. We have a unique group of businesses in Canada. We have a lot of monopolies. We have a lot of resources. We have a lot of things that other people need. Just right now, in the last 10, 15 years, maybe, people have been deciding to move their money the other way. I think when people realize all the structural benefits we have in Canada, there could be a chance that our multiples return to higher levels. But right now, it's just people don't want to own Canada. They don't spend enough time on it. That's what we do. And we think it's a great opportunity to invest in Canada.
What is it, Eric, now? 21 times for the TSX, but the S&P 500 is closer to 28?
Yeah, that's correct. Yeah, I mean, if you look at it, part of that can be a composition of the industries in Canada. So the discrepancy between Canada and the US really stems from the fact that they have a high concentration of technology companies. So that makes up probably, talking about, you take communications and technology together, you're probably talking about 40% of the market. So that trades at a much higher multiple than Canada. But also in there too, there's a lot of comparables in industries in Canada where they trade at a discount to their peers. If it be the railroads, as one example. Some other high quality industrials also trade at discounts to their peers in the US. So there's a lot of opportunities to invest in Canada. And the valuation discrepancy does get a bit inflated by the fact that you have a high technology weight in the US. But that aside, you're still looking at peers in Canada trading at a discount to their, the individuals in the US.
So greater risk, greater reward, but I want to sort of flip that on its head, Eric, because let's talk about the other side of that equation. We've got the big banks. What role do they play in anchoring a long-term portfolio, particularly given their track record when we saw the absolute dumpster fire in 2008 in the United States?
Yeah, so you're right. I mean, the Canadian banks make up a big part of the equity markets here in Canada. I mean, they're about 22% of the index. And I think when people think of financials, they're thinking, oh, they're risky, they're cyclical. But to your point, these are businesses that have shown their resilience time and time again. As you highlighted back in 2008 during the financial crisis, the Canadian banks were considered one of the safe havens. And you saw it most recently with the meltdown in the regional banks in the US. Same thing happened. And that's not by accident. I mean, the reality is that these are well-managed businesses, but they also benefit from the fact that they're oligopolies here in Canada. They're protected by foreign ownership rules here, by the government. So that's enabled them to build the business, grow the business, providing a variety of financial services to Canadians. They're also overseen by a strict regulator that keeps them on side with their capital ratios. But in addition to that, you also have them being very well managed. They're conservatively provisioned. So they can withstand the shocks that will come with the economy. So to us, they absolutely are part of the foundation of our Canadian dividend funds. And along all of that, you also are getting, like I said, a well-managed business generating attractive returns, but you're also getting a healthy dividend stream along the way. I would caveat by saying this, though, that with them being such a big part of the index, let's say there's 5 banks, 22%, we're going to own about 3 of them, and our weight would be between 13 and 18%. We just feel like having 1/4 of our portfolio in one particular idea is a little bit too much. It's a lack of diversification, but that aside, they are foundational in our funds.
Well, then let's diversify this conversation. Don, at risk of reducing Bay Street to hewers of wood and drawers of water, let's talk about materials and energy. That's about 30% of the TSX composite. How should long-term investors think about these sectors as structural hedges against inflation and, I suppose, geopolitics as well?
Usually when they're the biggest weight in the index, you probably don't want to own as much of them. But they do serve as a great diversifier in a portfolio. And what we found over the years is there's time to own gold, there's time to own energy. And what we found is when oil went to zero, which wasn't real, but no one wanted to own it. And it wasn't like oil wasn't going to be used anymore, but that was the time to have some in your portfolio. This year, gold is the hot story, and now it's 12, 13% of our index. We don't think that serves as a good diversifier, having that much in your portfolio, but having it that big a part of our market means we can choose the best gold companies in the world. Most of them are domiciled in Canada. The best energy companies are in the world. A lot of them are domiciled here. So we get to choose the best investments with the best risk reward to get those hedges that we believe are necessary in a portfolio. So when people don't want things, we have a great selection. I said, it's a good diversifier, but you have to understand just how much you should have in a portfolio. And I would say 30% would not be what we would put in a conservative portfolio.
So what you're basically telling me is resource exposure isn't a bug, it's a feature, and it offers some long-term inflation protection.
Absolutely. We've tended to find the best businesses with the best risk reward, and we invest in it a little differently. We often will have our exposure through royalty businesses, which don't have the same capital intensity, but do provide participation if the energy or whatever the underlying commodity price will be. In fact, right now, we think a great diversifier in the portfolio is adding names like lumber, which people do not believe, but at a small weight. Because when people don't like things, if you can buy the best one in the world with the best balance sheet, there will be a time it works for you, and it'll probably work when nothing else does. So we don't mind investing a little bit of capital in things that aren't going to work with the knowledge that they probably will 3 to 5 years from now.
We've established why Canada still earns a strategic place in a long-term portfolio. Don and Eric remind us that valuation discount is only a problem if the underlying business is weak. So let's apply that to real-world trade tensions, shifting rate paths, and political noise. Don, you've been discussing with clients the unpredictable U.S. trade policy, geopolitical instability. How should a long-term investor position themselves without overreacting to the daily headlines?
The daily headlines do not do any favors to people trying to decide when to buy or when to sell something. In fact, we find that they just create more uncertainty. If you read the headlines every single day and try to invest accordingly, you probably will want to go under a rock. And if you're trying to invest based on governments are short-term, unpredictable. And so what we do instead is really focus on the businesses and making sure that we own businesses that the management teams have been around for multiple cycles and they're invested with us. And so they're thinking long term. And if you have a great management team and they're thinking long term, they basically do your job for you as a portfolio manager. So we spend a lot of time during these political uncertainty moments talking with the management teams, getting their insight and understanding how they're going to navigate these very uncertain times. And as long as they're on top of things and we own companies with balance sheets that are set up to win long term, it allows me to sleep really well at night. And I would say that like having a great group of businesses allows you to get through any kind of cycle. But trying to guess when to buy because everything is okay, it's a terrible investment strategy.
I've never really heard it put that way before, but I think you've made an interesting point that our investments will outlast the governments of the day.
The best management teams are the ones that are really thinking long term, really get capital, understand how important it is. And, it's not hard to look and talk to them about how they're compensated. And we spend a lot of time on that. But if they own a lot of shares, we feel good about that. We even go further than that and we say, does the board own a lot of shares? And over time, when we found the board and management's aligned, it usually works out well to be a long-term shareholder.
Yeah, you want to see that the people at the top have their money where their mouths are. Eric, help me out though, because I know from your work that you trim positions when prices run ahead of valuations. Headlines can have an impact on those valuations. So how do we balance taking profits with maintaining a long-term conviction in a high-quality Canadian company where management's thinking more than the next quarter, they've also got skin in the game, and they're thinking about the future?
Yeah, I think it really comes down to balancing risk reward. I mean, in an ideal world, you'd like to buy the 30, 35 best companies and put them away and let them run for the next 20 years. With us, we do have a core group of those type of businesses where our goal is to own them 5, 10, 15 years. And in many cases, that's been the case. We've worked together for better part of 20 years, and a lot of those names have been with us all along. But with the market being so dynamic, valuations can get dislocated, like you talked about headlines. Like people can get a little overexcited about a particular idea and a particular theme. So our job is to manage that risk reward, to make sure that our unit holders are getting rewarded for that risk. So there will be instances where we will trim back the position and maybe we'll be raising some cash just because we feel like the risk reward isn't balanced in the market right now, or we'll be redeploying it into a new idea. Sometimes they get so over exuberant that you almost have to say, okay, it's time to leave. We're going to sell, redeploy the capital somewhere else. We'll put it on the watch list. It's hard to do, but it's a discipline that you need to do because you want to make sure that you're getting rewarded for that risk that you're taking.
So tell me a little bit about that secret sauce. What is it that you're thinking about specifically? Like, how do we make that decision? How do you say this is run ahead of itself? It's time to cut and run.
Well, it really comes down to when you look at, okay, well, what's the valuation? So depending on the industry, depending on what the growth dynamics are, what you're expecting, where margins are, and you get into a situation where all of a sudden, let's say you were buying it at 15 times earnings and you think that this is a high quality business that's misunderstood and should trade at 20, let's say. But if all of a sudden, let's say it becomes an AI idea, and all of a sudden you're like, they're building in an assumption of what's going to happen over the next 10 years. And you're like, well, that might be a little bit too aggressive. That's the opportunity where we'll say, okay, if we think it's worth 20 to 25 times, if we're now trading above 30, now it's time to maybe take that weight from 4 to 2. So it really comes down to the relative risk reward. And like I said, depending on the circumstances, if it gets so inflated, we will exit the position. So it's every day reevaluating, making sure we know what we own, why we own it, where are we wrong. So we don't just do it based strictly on valuation, but when you own these companies for long enough, you start to realize sometimes you're investing with different types of investors. All of a sudden, it's gone from a value name to a momentum name. And in those circumstances, that's likely when it's a little bit of a light to say, maybe it's time for us to be trimming back our positions.
We've talked about the importance of, avoiding market timing and being disciplined and sticking to a game plan. Having said all that, Don, where do you see interest rates in 2026? Is there opportunity within the changes that we anticipate next year?
It's interesting when you run a dividend fund. A lot of people are buying it for stability, income. We look to be better than a GIC alternative. And what I think happened in the last few years is the people got really scared. They piled into money market and other instruments, and they were getting paid. And when interest rates, and all of a sudden you could be in a money market fund and get 5%, or you GIC at 4%. That didn't happen for a lot of, I'd say over 10, 15 years as interest rates went close to zero. As we see interest rates lower now, the GIC doesn't look so attractive to people, and they're realizing the opportunity cost of sitting in very low interest rates too high. A lot of the businesses that we own, which are very stable, dividend-paying businesses, can become more attractive. It'll help their cost of capital because they're going to lower their refinancing costs. But these are businesses with growth. And if you ask me if I could have a 3 or 4% dividend yield that's growing 5% for years and years to come, that's a lot more attractive. And so for us, it's about identifying the businesses that can grow their dividend with a good plan. And we think that they'll be more valuable as rates come down. It's interesting because, there's a lot of haves and have-nots, but we found that, usually when people are so confident about certain types of business, eventually they'll take their money out of everything in AI and everything else and realize that, a 5% dividend yield with a 5% growth rate, that's a pretty good business. And we have a lot of those in the portfolio, a lot of those in Canada. And so we think that the multiples will probably go up.
You didn't bite. You didn't play my game. You didn't tell me where you think interest rates are going next year.
If Donald Trump is going to control the Fed, and then the Fed is being told to lower interest rates, the rates are going down. What you can't control is the long end of the curve. If inflation is going to go up because of policies that go in place now, that's the interesting part, is you can't really control the 30-year interest rate, which is really important on the mortgage and side in the U.S. In Canada, we have pretty low rates right now already. So I think what's going to happen is we will probably continue to lower our rates, but not at the same pace, because our rates are so much lower already than they are globally. So there's only so far we can go without the US going, or our dollar will be worth nothing. So yeah, I would say interest rates are coming down. I think the inflation rate will be important to watch. But yeah, that is the problem in the US is I think what they'd love to get down is the long end, because that'll really help housing. But they can't really control that. Lowering the short end will help small businesses for sure, and probably spur on M&A, which will get people more excited about the market yet again.
See, I call that the dinner party question. You've just given me information that's going to make me look like the smartest person at the next holiday party. So volatility is the setting, not the story. Don and Eric remind us that great businesses outlast governments, the daily headlines, and economic cycles. Long-term investing works when management is aligned, capital structures are strong, and discipline trumps emotion. So let's take that philosophy and put it into practice. Eric, you've emphasized that the goal is a concentrated, high-quality portfolio. What's concentrated mean, and how do we define high quality?
So concentrated, I think, is different for everyone. For us, we look at a concentrated portfolio of, let's say, 35 to 40 names. We feel like that gives us enough breadth to be, able to invest in a variety of different sectors, different ideas. But the thing we're very careful about is, trying to avoid getting into a theme, like too overly invested or too concentrated in an idea, because we've seen over the last 20, 25 years, the market can have a tendency to run towards a certain theme. It could be the internet boom bust of the early 2000s. It could be the number of energy, booms and busts we've seen over the last 20 years. It could be the Amazon effect. It could be what we're talking about right now, the AI effect. So our job is to make sure that we have exposure to those industries, but making sure we're not overly concentrated to one of those themes. And in some cases, you have to be careful, because you can think you're buying a utility and you actually are buying, you all of a sudden realize you're buying an AI name. So our job is to make sure that we're very diversified across that, concentrated to the sense of 35 to 40 names, but very diversified with those ideas. When it comes to high quality, it really comes down to, four tenets, which is, first is it's a high quality business. So what's a high quality business? These are businesses that have very resilient business models. So they have, high moats to their business. Like we talked about the banks earlier, we can use the railroads as another example. We want them overseen by very strong management teams. Don talked about that earlier. We want management teams that have a track record of allocating capital, that are looking 3-5 years out. They're not managing to the quarter. Third, we also want them to have very strong capital structures, because we want them to be able to make good decisions regardless of the market environment. The last thing we want is to get into a situation where these businesses have suboptimal capital structures and they're forced to make bad decisions because they don't have the financial flexibility. And then the last part of that is buying those businesses for less than they're worth. That really kind of comes down to finding the high quality business with the moats, supported by a management team and a balance sheet. And that's what I would say is quality.
You brought up a very important point about concentration and diversification. Those aren't mutually exclusive. You want to have that concentration of high quality businesses, but you do still need to be diversified. But the thing that I think investors sometimes misunderstand is that risk is not volatility, but a permanent loss of capital. So how should we as investors guide our long-term selection and position Canada within a model portfolio?
So as we talked about, we use our process, focus on high quality management teams, high quality businesses, attractive valuations. And really what we're trying to do is build a diversified portfolio. And part of that diversification is making sure we manage weights. So as we talked about earlier in the conversation, when things get a little ahead of themselves, we'll trim them. You shouldn't expect, with our focus on protecting capital, you shouldn't expect to see weights in the names get up to 8 or 9% and there be 3 or 4 of them in the fund. Typically, our goal is to have 35 to 40 names with a 2.5 to 3% weight, watch them grow. And when they become, hopefully they all become, a bigger part of the portfolio. When they get over 5-6%, we trim them and redeploy that capital, always with the goal of making sure the fund remains diversified. It's a concentrated portfolio, predominantly in Canada. The goal really is to make sure that every day is a good day for our unit holders to buy the fund.
Don, we started our conversation with you, so I'd like to end it with you on something that you just threw away as a casual comment about how Canada, on a valuation basis, is underperforming the United States, or at least cheaper valuation-wise than the Americans, but that could change. Are you expecting it to change in 2026? And what would it take to make that happen so that we are on equal footing with the Americans? Is it us that rises or them that falls?
When I look at what everyone's trying to do today in their investing, is they're always trying to find out, and it's all been about themes. We've seen this for 30 years. And right now people are trying to figure out, okay, how does the business I own participate in AI? Like, that's the theme right now. And right now it's a haves and have not. And if you're perceived not to have exposure to AI, no one wants to know you. And I think that's a big mistake. And what we'll learn is that when everyone wants to buy something, it creates opportunities to buy something really cheap. And we have a lot of parts of our market that aren't obviously participating in that trade, but are still great long-term businesses. And anytime you get a chance to buy great businesses that no one else wants, it gets you great long-term returns. It's just like the best time to buy a house was when no one else wanted to. We all saw what it was like to buy a cottage in COVID. You couldn't buy a cottage because everyone thought we were going to work from home for the rest of our lives. And now people are just trying to get rid of those those cottages. I call them a business. So for my side, when people want to come to Canada, it's a relatively small market. When you want to buy the great businesses in Canada, you're going to have to pay up if you wait till everyone else decides they're good businesses. We still have a great economy. We still have educated workforce. It's a safe place to be. And just imagine if the government actually puts in policies that reward Canadians for investing in Canadian businesses like they used to. If they incent pension funds to actually invest here instead of throwing their money at everyone else's business across the world, I think that could happen. Better depreciation policies, better intraprovincial trading policies. There's so much that we can do that could just change the narrative in Canada. And if that happens, people will see Canada can grow faster than the rest of the world. We have the natural resources, we have the know-how. And so I'm optimistic that our economy can actually grow faster once we realize that we are a great population and we can do things well ourselves and not worry so much what the US is going to do. And so I think when that happens, Canada could trade at the same multiples as the US. And just that would be a 20 to 30% change from where we are today. And so are we counting on that happen? No. But, it doesn't take a lot to imagine that happening. And during my career, there's been a time when all the best businesses in Canada did trade at a premium. And that may happen again. I just don't know. We're not counting on it, but the opportunity is when no one's counting on it.
So, gentlemen, if there was one thing you wanted a Canadian investor to know about the Canadian market going into 2026, what would it be?
I would say don't underestimate it. I think we have a lot of high quality businesses here in Canada that right now is being overshadowed by trade talks and tariffs. And I feel like if our government can do what they're promising, Canada has a lot of opportunities and a lot of investments that are going to be made that could grow the economy over the next 5 to 10 years.
The worst thing you can do is wait for us to do a trade deal. Because if we do the trade deal, I hope we do, it'll be too late. And then the uncertainty is gone. And you want to buy when there's maximum uncertainty, not when the market knows what the deal is going to be.
Gentlemen, thank you so much for your time and the insight. All the best for the holidays and all the best for the new year as well.
Thank you very much.
Thanks very much.
So today I learned from Don and Eric that Canada's structural strengths still matter. A market tilted to banks, resources, and other cash-generating businesses can be a powerful engine for long-term compounding when you focus on companies with strong balance sheets, durable cash flow, and management that's aligned. We also learned today that volatility in politics, they're not the reason to abandon a plan. It's that environment in which active managers look for mispricing, and so should we. Also, a durable Canadian portfolio isn't about owning everything. It's about a concentration, but high-quality names diversified, a discipline that insists on a reasonable discount to value, and that constant emphasis on protecting capital before chasing return. Canada may be the forgotten land of opportunity when global investors only look for headline indices, but for investors who think in decades, not days, that forgetfulness is exactly where the opportunity puts us on the money. I'm Michael Hainsworth. Thank you for joining us.